Right, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for May 9th, 2015. I want to start off by letting you know there's a number of folks uh, and I have been talking about doing an additional weekend report that was geared more towards the longer term time horizons. This webinar is really geared towards the week ahead and what I would consider to be tactical trading, the intraday trade and maybe short swing trades and specific tactical changes on the report. But a number of folks are interested in the longer term, say the weeks and the months, maybe more like um, investigating things from BMR or from the ETF2 or looking at some um, charts on the weekly and monthly time frame. And so I'm putting together some ideas on how to do that. It would probably be a separate webinar. Also on Sundays, which I will record and keep on a separate channel. And these would be some things that look at longer term opportunities that take weeks, months, and quarters to develop. And in addition, I think the folks involved in that one are probably going to pick up some of the research or knowledge sharing on a rotating basis too, so that we'll get some additional insights into that. So some ideas for the longer term trading starting, I should come out like this week, I think. We'll kick those ideas around and let you know. Meanwhile, I'm going to talk about some things in treasuries, the long-term treasury, where exactly that kind of idea is shaping up and what's triggering the ideas behind that. For some of us, the blended month rebalancing is fine, but it doesn't necessarily catch those changes in intermediate trends that are occurring mid-month. So we wanted to get some kind of insights into those and maybe some longer term things that occur over the weekly and monthly time frames. So more to follow. Meanwhile, we added a couple more folks for the research weekend and the live trading this week. And so there's still time to do that, but I think it's going to make the distance learning option even more attractive based on some of the work these two guys are adding. One fellow's going to work on an intraday and an overnight holding system based on some things we were working on in the last day trading workshop. He's got about 6 months of data to share on that one. And another fellow who has done basically an initial self-assessment in terms of beliefs about system, self, and market and combining it with brain mode power in order to get off to a good start with the Tortoise systems. We're going to use his research as a way to start with his beliefs and objectives and then map that to our various different strategies to see what the best way forward for him might be. And I think that has some payoff for the rest of us as well. So that'll all be in the distance learning package too. So even if you can't attend, I'd invite you to think about getting a hold of that. So more to come on that as well. Okay, so let's get started then with the weekend report for May 9th. Market is still bullish normal on a long-term basis using weekly RSI 14. We are in the upper half of neutral at 59 out of 100 on an annual basis. On a short-term 10-day basis using the 10-day NDX, we are overbought at 85 out of 100 with that big gap up and strong follow through on Friday. Turned what was looking like an ugly week into something interesting. The week ahead should be really interesting. Looking at the market mosaic price with respect to the 200-day moving average is yellow bullish at 4.96. So we're still 3% above the sideways market condition. Slope of the 50 went negative and is red bearish at 0.03, minus 0.03. ADX remains a weak 13. Although the ADX is up, it still hasn't crossed back over the 15 threshold. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. That current reading is at 0.997, so we are just into risk off. When we take that score of 0.997 and compare it to the last 5,000 trading days, we find the average and the standard deviation to compute the risk Z, which is now at minus 0.11. This histogram shows you the 90-day time series of that indicator, and we peaked at 1, and now we've had an increase in that volatility, and it now just tipped into the negative area. And now it gets to be really interesting is to see whether or not this double bottom and volatility holds, or if this is a turning point where we would have a high, a lower high, and now getting ready to violate this threshold here. So in my sense, we had some really negative price action last week that was saved by a decent jobs report on Friday. But this is still a market that's on the short-term edge of collapse, as well as you can make an equally strong argument that it found support on Friday where it was supposed to and rebounded. So this is really a trader's market in the short term, and a good trade can be framed in either direction. And so this is good for intraday and short-term swing trading in my view. Blended monthly rebalancing, the next reevaluation is due 1 June. These are the current holdings for ETF 13, 22, and 32, and you can see the current leaders based on Friday's close. The GUR is a European index, and the strength in EFA, the European portion, that was also noticeable. Strength in the Dow 30 with JP Morgan, Cisco, Disney, United Health, and General Electric. In ETF2, the theoretical exposure remains at 100%. The model is at 100%. However, there were 3 sells this week. There's actually one sell in EPI where the stop was hit, and then we're selling Thailand and the Dow Transports by rule. And out of the top 10, the stack that we're adding all are of a European flavor. EWI is Italy, EWG is Germany, and SCZ is a broad, multi-country based small cap European index. And that will keep us at 100% exposed. And those last transactions, the 3 purchases happen at the open on Monday. Just a quick look at the ETF 13 and 32 portfolios. Japan and Europe remain at the top, along with U.S. tech, and then emerging markets moving up into 4th position here. Treasuries, real estate in Australia remaining in cash at the bottom. In the ETF 32, China, Japan, emerging Europe, that's that GUR, that was part of the impetus behind the SCZ position as well. You notice that in the 3rd position here, a 1-week score of 2.49, 1 month 5.74, strength on the 3-month, but it's still negative over the last 6 months. So that tells you that they are not even fully out of the hole yet, but are accelerating past the U.S. domestic choices, and that looks like a continued shift to Europe as the euro begins to regain a little bit of its strength relative to the dollar. Inside the ETF Max, still dominated across the board by China, although as we mentioned last week, some real possibilities for moves away from that 3 standard deviation up move, and that came through this week with exactly that kind of a response. What will make this interesting now is to see whether or not that's the first leg of a multi-week downward move in order to preserve that 3 and 6 month gains. So there's some opportunities for value plays in here, or also a reversal in momentum. Meanwhile, the solar gave up just a little bit, 10. You see Russia on the basis of strength in the energy sector coming in. The S&P Biotech is really the first thing you see besides the China and energy based with XBI. Still mostly China, Asia, Japan, um, and now down here where you see Ireland, Denmark, and European small cap dividend with DFE are starting to show some interesting moves as well, and that also supports that idea of that SCZ and the broad-based EFA as a symbol, by the way. So we got Austria and copper. Not too bad. It still had an extraordinary month at plus 14. This week was down minus 1.71, and we know that that's considered a front runner for the business cycle. We talked about that at length last week. Still an interesting play and one to watch carefully. In fact, the movement of copper is one that we would expect to add to that weekly review of important bellwethers, looking at the longer term system dynamics. The S&P 500, Netflix, Martin Marietta, and Vulcan Materials really turned in a continued strong performance last week. I'd be looking for opportunities for more momentum in there. Also, Amazon, Equinix, and Electronic Arts, and greens all the way across the board. Perigo is interesting in that it's green on 1 week, yellow on 1 month, and then green over here. So maybe the rebound from that 1 month pullback has already started, and there's some potential momentum there. Estee Lauder and Goodyear Tire. Goodyear Tire, very interesting with greens across the board. And now Walgreens. Greens on the 3 month and 6 month, red on 1 month, but above average here on the 1 week. And so maybe that's a short-term pullback that has started to rebound. So Walgreens bears some close attention as well. In the market health check, I want you to notice. Make that a little bit bigger. So what we have here is the vertical blue lines are 10, 20, and 30 days worth of look back. The purple line is that key previous swing high right here at 211 and a quarter that has been the source of some volatile moves here this past week. It's still acting as resistance in my view right now, since it failed here like three times. So now we'll see what kind of a week is. Is this the week where the triple bottom at 207 holds and off it goes to make a new high above 212? Or is it going to fill back into the channel here in the yellow zone between like 211 and 205? Some of that momentum started to come out of the market this week. If you look at the last 10 days and compare that to the middle 10 and the third 10, days 30 through 10, minus 30 to minus 10 are generally up, but the last 10 have been generally down. And so you can see how the slope of the 30 had gotten up and then started to roll over. So this price on Friday is actually an anomaly compared to the previous 10. So we've got to see if that's an outlier or if that was the signal of new strength and that in fact 207 is going to hold. That's what makes this a horse race. But the slope of the 10 is down. Now it's with price up here in the green zone. Any move above 211 and a half or 211 and 3/4, or basically call it 212. I'm long because it's going to go up and test 212 and a half, and it gets past there, off we go. But if it takes out Friday's low at 211, then I'm looking to get short tactically intraday and with aiming back towards 209. Or the middle of the river. The river is that dark blue shaded area, the 30-period Bollinger Band plus or minus 1. The floodplain is the Bollinger Band plus or minus 2. And then you can see the vertical blue lines are 10, 20, 30, 40, 50, 60. I just think we've got a really interesting market right here. The dragon has rolled over, and then that gap up on Friday caught a bunch of people by surprise. And you can see how that It may have just been a tactical play for people that were going short with their stops up in here. So it's really going to be a trader's market these next 2 days, in my view. We've still got about a 5% gap between us with the price here at 211 and the 200 period moving average down here at 201. So there's still a little bit of a cushion, but you can just see how choppy that market has been for the last 60 days. We basically have stayed in this range between 212 and 203, 204. It's been some heavy sledding in there, and it's been paying us to take our gains when we get them and to cash those winning trades tactically, and remember to keep ringing the bell. So that's going to continue to be my focus going forward. Now, what's a little bit problematic here is that if we look at that for the long side, we see the ADX has ramped up. It has rolled up from below, from about the level of 10 up to 13. But right now, the bears are in charge because of that pullback over the last 10 days generally. But the Friday move, again, has moved that plus DI up, and they're about ready to cross over. And so it really is a crapshoot for ADX right now as to which trend is stronger. Right now, my opinion is that the long side still has strength in it based on this move of the last 30 to 50 days, which is still generally up. I mean, the river is up, the dragon's at the top of the river, but right now it still has to get through 212 to be convincing. So an interesting week ahead. In ETF2, all of the indexes are on buy signals. That keeps us at 100% invested, 0% in cash. Bullish normal. EFA at 56 is stronger than the S&P at 51. Inside the U.S., it's technology at 53, then mid caps at 51, small caps at 51. Tie break goes to the mid caps because of their average score here. Slightly better quality rating. And then followed up by the large caps. The two strongest sectors, Japan, and this should read technology, and then the two weakest, Latin America and Asia, less Japan. No change there. The U.S. large caps still suffering here in utilities. Consumer discretionary and healthcare are about those two defensive plays still doing pretty good as far as the large caps go. But otherwise, money continues to flow out of U.S. large caps toward other sectors. And the big beneficiary right now, as you'll be able to see, has been Europe. In the market health check, the world market model, I'll let that come up on your screen. Okay, there we go. Sorry, we had a little network hiccup there. All right, so in the world market model then, the U.S. is all above average except for small cap value. Exceptional outperformance, Netherlands and Austria, private equity, Japan, China, Hong Kong, Singapore, Taiwan, and Korea above average in Asia, but you can see weakness creeping into the former leaders here in Asia. India, Thailand, Indonesia, Vietnam had been near the top of the gains, but are now rotated back into the red. Meanwhile, everything Europe is looking actually pretty good, and it's looking better than the U.S. And that accounts for the rotation in ETF2 towards Europe. Just a quick look at the Dow. Goldman Sachs has moved to the top. Some financial names have really joined it. You got Goldman Sachs, J.P. Morgan, both green and white. General Electric's financials are looking pretty good. IBM and Microsoft are both making a move. IBM is green and yellow, Microsoft white and yellow. A little bit of weakness creeping now into Home Depot and Pfizer. Visa in the financials moving up. But the financials are really a stock picker's task right now with American Express and Travelers down here in the bottom of the stack. Meanwhile, United Health and Disney greens across the board, as is Apple. Some good strength there. Shifting to the daily. Okay, so on the daily report, no signals in channeling and overreaction. We got a handful of triple screens and 551Ws, Apple and Chevron, and then almost a dozen in the auto framer for based on trade location. Asia list, Japan, Treasuries, AT&T, small caps, Microsoft, VIX, emerging markets, Chevron. I like Chevron for the reason that the energy's been having some rebounds, and they've got both the 551W and a very favorable auto framer. Disney is a nice one too because that's near the top of the stack in the Dow, and is also well-positioned auto framer. Pfizer, interesting on a value play. That's a former strength leader that has some room to the upside as well. Inside the Dow 30 summary, again, a handful of dojis, a couple of 551Ws here in Apple and Chevron. Apple at almost 4-1, Chevron at 2.5-1. Both are 551Ws. Chevron has the advantage of being a strong frog quality number. Because of the big gains on Friday, no RSI2s. You can see how close to 100 they all are. But we've got quite a lot of frog candidates in here. Notice Cisco with a 4.3 frog and only a 10-cent intraday standard deviation. So that one should be of interest. The big winners Friday: Visa, DuPont, Boeing. The big loser Walmart was down 0.5%, but you can see Visa was up 4.3. So some differentiation occurring inside the Dow 30 that can be traded. Inside the ETF 30, half a dozen test out well on the auto framer, quite a large number of good frog candidates as well. The volatility trade is still a tough one. I can't swing trade it where it is right now, but the intraday moves are certainly tradable. And then to wrap it up with some auto framers candidates. All of these are better than 2-1, and you can see all the numbers that you need to compute some your mechanical trades. And then the regression line framework. The symbols in the green, this top stack, again, these are the ones that are the most below their 270 regression line. So Procter & Gamble is lagging the long-term fair value by 6.5 ATRs. Walmart is 5 ATRs below its long-term fair value. The strength in technology plus Intel being 4 ATRs below its long-term frame makes it interesting. And then the ones in the bottom stack, the ones in the red down here, these are symbols that are the most ATRs in front of or higher than their long-term fair value. So IBM, General Electric, Caterpillar, Morgan, and ExxonMobil, rounding that stack out. Treasuries is really interesting to me. 6 3/4 ATR below its long-term fair value. And so that's what got me interested in looking at some of the longer term setups. And I want to shift to that now for the charts of interest. Let me pull those up. All right, so the this is a about a 5-year, almost 6-year look at treasuries on monthly charts. And what got my attention in this RLCO framework was this pullback. What we out here in period number 9, what I'm calling period 9 is a Z trade in the other way. It went from 137 down here to about 122 in a matter of about 4 months. And that's a pullback from Z plus 3 all the way back to the edge of the river, so Z plus 1. So a 2 standard deviation move back. And it's right now inside the dragon. And the dragon is right along the edge of the upper river. And you can see that the river is sloping up. So treasuries have generally been on the move up. But this last move took it from 100 to 137 in about, over the course of a year. Quite a move from Z minus 1 to Z plus 3. Well, as I started looking back, I looked at all of these previous excursions that got out to at least Z plus 2 over the last 5 years. And then I looked at what happened after that rolled over. In every case, it rolled back to find support within the dragon. So if we go back into 2005, it went from Z plus 2.5 down here into the bottom of the dragon, found support, and then made a nice move up. Got to the edge of Z plus 2, pulled back and found support in the dragon, moved up to Z plus 3, pulled back and found support in the dragon, moved up to Z 3.5, and then came all the way back into the dragon, and still generally held above the Bollinger Band mean in period 4, followed by a nice move up to Z plus 2, and then back to find support in the bottom of the dragon, down here north of Z minus 1 in every case. Then I moved to Z plus 3, back into the edge of the river, up to Z plus 2.5, back into the dragon. Now, in period number 7, this is the only time that the pullback did not form a base of support inside the dragon, so instead of rebounding, as we'd have been led to expect in the previous ones, it actually gave us another leg down, followed by a bad month for the treasuries here, and then collapsed all the way down to just the bottom, just barely going outside of the river. But then that turned into period 8, which had a double scoop going up. You can see right here in this little hammer, that was where if it was going to fail at the edge of the river, it would. It didn't, so it actually put in a second leg up. And now here we are in period number 9. After Z plus 3 move, we're now back to Z plus 1 in the middle of the dragon, and therefore I am believing that TLT is entering a stalking zone for entry on the longer term hold, on the long-term monthly chart. And the question as a trader we put to ourselves is this moment here in 9, where this little pullback has now occurred, an orderly pullback, is that more like 7, where given the opportunity to rebound, it didn't, it gave another leg down? Is 9 like 7, or is it like 1, 2, 3, 4, 5, 6, and 8? In which case there was a measured move up after all of these support levels. I think it could be the case of both 6 and 7, where it got out to Z plus 3, pulled back to the dragon, and the dragon was on the upper, the north shore of the river in that case. But right now, I think if it finds support here, then that means 122 or 120 is a nice support level, and then off it goes back up. But if it fails out of 120, then the next targets are the Bollinger Band mean at about 112. So there's an 8 to 10 point move on the downside in treasuries should they fail here. And then if that fails, coming all the way down to the Z minus 1 level around 102, so another 10-point move to the downside. But if you notice throughout this entire 5-year period that all those pullbacks never violated that Z minus 1, so the bottom of the river for the conservative investor might give you the reasonable price target. So if you were buying it right now around 122 with about a 20-point move, that's about a 15% stop loss. I think we can start buying some initial long-term positions here, particularly since the shorter-term swing trade move is on for the treasuries. That TLT is in a favorable posture for swing trades using the auto framer and using the regression line fractal framework. So that's the when I sent that note out around, a couple of our RIAs, our registered investment advisors, sent some info back, and we were taking a look at and I had a short discussion of treasuries using a couple other lenses. Here's one using point and figure charting. If I can get that pulled up just a minute. All right, so this is a 20-year look at TLT, the long bond, using point and figure. And what we notice from this chart here is that this recent trend line, this support line here for this last move up to 137, had a lower high, rolled over, made a lower low, yeah, so we're talking about this trend line here. After making a higher high and then a lower high, has now violated this lower low and is now, in the words of the sage, on the edge of a precipice. So let's take a look at that a little more closely. Again, so here's the trend line using point and figure. Here was that double top that took out that high, and then it broke through all the way up to here. Sell off at a rebound, couldn't make a new high, rolled over and made a new low here. So now it's poised to violate this support level. And that puts 112 is the next price level, and then 103, 102. I think we looked at using the RLCO framework. So that's what it looks like on point and figure. That means we would call that a critical state in treasuries. If you look on this one, we looked at the downside as being with the RLCO down here around 102, sure enough, and then 112 being the support level here. And that's if this one fails at about 120. All right, so we really have a critical state that if we get a rebound, we should be able to get up to here, or at least to this price level, which gives us a tradable moment. Right, so if this, come on. So if this, darn it, why isn't it giving me that? Give me a pen. Yeah. So if this price level here fails, we're looking at 112 to the downside and a second failure down here to 102. That's about a 15%. That's about a 15% move. But if it holds here, we could expect to see, according to point and figure theory, a move at least up to about here and a test of up to here. And if it gets beyond here, off it goes. And again, that's about a 15% move as well. So this is really a critical state in treasuries based on the RLCO framework and the point and figure framework. Now let's look at one more lens. So now looking at weeklies on the for 3 years on treasuries, we can see down here we have the weekly double bottom with a MACD divergence and a squeeze, and that's when the squeeze is defined as when the Keltner channel is inside the Bollinger Band. That means the recent price action has been compressed inside the volatility bands, and when you get the breakout, you get a major buy signal, and that's what's noted. This breakout here corresponds to that breakout. That's when the squeeze expands. You get this extraordinary move all the way through, and now this is the momentum indicator here, and you can see that goes negative right about here after this big move. We know this was a Z plus 3, a Z of 3 up here at this price level, and yes, it's come back to now this double bottom. This was that lower high that you saw reflected in the point and figure chart where it's failing this way. And so now momentum has opened, the jaws have opened to the downside. And so this double bottom period right in here is really crucial. If it's failure, it moves to 112 or 102. If it holds and rebounds, the move is as high as 137. So as a flight to quality target, if money keeps flowing out of the large caps, you would think treasuries would benefit. But the weakening of the dollars may be making that not as attractive as Europe as a destination for equity. So if equity money is rotating out of the U.S., both equity and bonds, then you wouldn't be surprised to see treasuries continue to collapse here and money rotating into Europe in the weeks and months ahead. So that's a quick look at the treasuries. There's some longer term implications for what's going on in there. Maybe we have time for a quick look at the TLT on the daily chart. Let's see if we can't do that. Now this is a picture of treasuries. Now this last 10 days has actually been a pretty good swing trade for us on the short side. In treasury, we initially had this one set up as a long signal, trying to get up to the RL 270 at 132, but it failed, and so we took the 1 hour loss, and then that was a stop and reverse because it had taken out the swing low, and this gave us a nice swing from 127 down to where we covered here at 121. We actually got a second position short at 122. It hit Z minus 3 and rebounded. That caused us to get out and then reverse here at 120, 150. So we've got the first of the tactical swing trades in with 2 days of momentum, and our target here is up around 128. But again, if this doesn't work, and we're playing this one day by day because of the magnitude of this big move down, if this fails here inside the dragon, notice the dragon is going down. So if this fails and rolls over, this will be a quick exit on that swing to cash in the win from 120, 150. So if this rolls over, we'll get short again down here around 122, and then it's look out below going down to 112. But otherwise, if that works, then we're thinking 128.50 is the target, and then 131.50 is the far side of the river. So we've got some interesting swings and intraday trades available to us here in TLT. But after losses of this magnitude, I would not be surprised to see it come up and find support around 128 before failing. If so, that's going to be a nice swing. So lots of interesting moves here in the treasuries with implications for the equities. Okay, so we've been going at about 50 minutes. I know it's late. It's Mother's Day. I'll get this recorded and produced and hung on YouTube. The slides are already in the chat room, and I'll post the link in there as well. Otherwise, looking forward to a very interesting couple days ahead. And again, I'll keep you posted on what we come up with for the weekend webinar with longer term time frames. I see more of that along the lines of what we just discussed with treasuries, and then using this workshop or this webinar more for the tactical trading. So I see by aligning these with time frames of interest, then you can focus on the things that you want to focus on. And like always, we'll record both of them and make them available to subscribers. That's everything I got here from Kansas. You guys take good care. Have a good rest of your Mother's Day. And remember to take care of Mama. Take good care, and we'll see you in the chat room.